Hello there, I am Robert Yee, a mortgage loan originator, and I specialize in helping seniors tap into their home equity to strategically plan their retirement. I also have over 20 years in residential real estate experience. This is a plain language guide to how your home equity can strengthen your retirement on your terms. In this presentation will take less than 20 minutes, and the purpose is to bring education and understanding to the home equity conversion mortgage. The asset hiding in plain sight. Most retirement plans focus almost entirely on investment accounts, 401ks, IRAs, and savings. But for millions of homeowners, the single largest asset on their balance sheet sits untouched, their home equity. According to Federal Reserve data, homeowners age 65 plus hold an average of $200,000 to $250,000 in home equity, often rivaling or exceeding their entire liquid retirement savings, and yet it's rarely included in retirement planning conversations. The greatest reverse mortgage of all time, as told by Shelley Giordano in her book, What's the Deal with Reverse Mortgages? This happened in France back in 1965. Jeanne Calmet, age 90, had no living heirs. Her neighbor, an attorney named Andre, aged 47, had his eye on her apartment. They struck a deal. The attorney would pay Jeanne 2,500 francs per month for the rest of her life, and when she passed, the apartment would become his. So what happened? Well, the attorney died in 1995 at the age of 77, never having moved into this apartment. Jeanne was still alive at 120 years of age. In fact, she went on to live 122 years, 164 days, and she's the longest confirmed human lifespan in recorded history. By the time she passed, the attorney's estate had paid more than double the apartment's value. Her only comment in life, one sometimes makes bad deals. So what's the lesson or moral of Jeanne's story? Well, her deal was brilliant, but it had one major flaw. There was no protection for the other side. The modern HECM is specifically designed to solve that problem. In her deal, there was no federal protection. The attorney's family kept paying even after his death, and one side bore all the risk. The HECM today is FHA insured and federally governed. It's a non-recourse loan, meaning you, your estate, and your heirs never owe more than the home value. Both sides are protected by law. The key insight: longevity is unpredictable. Home equity is your largest asset. Plan for a long life, not just an average one. So what's a reverse mortgage really? Well, it might help if I tell you the four nevers to clear up some of the myths. Number one, you never give up title. You remain the homeowner. A reverse mortgage is simply a loan secured by your home, not a transfer of ownership. Number two, you never have to make a monthly payment. No required principal and interest payments for as long as you live in the home and maintain it. You never owe more than the home is worth. The HECM is non-recourse. If the loan balance grows beyond the home value, FHA absorbs the difference, not you, your estate, or your heirs. And number four, you never lose the home to the lender. Stay current on taxes, insurance, and maintenance, and the home is yours for life. Well, at least till the age of 150, or if you pass or you cannot live in the home for 12 consecutive months, that would be considered a life event. What are the 5 risks every retiree faces? Well, home equity used strategically can directly address 3 of these 5 risks. Number 1, longevity risk, outliving your money in a 20 to 30 year retirement. Sequence of returns risk, a market crash early in retirement can permanently damage your portfolio. Liquidity risk, wealth locked in assets you can't easily access when you need cash. Inflation risk, the rising cost eroding your purchasing power over time. Healthcare cost volatility, unpredictable long-term care and medical expenses. A credit line that actually grows, one of the most powerful and least understood features of the HECM. Unlike a traditional home equity line of credit, a line of credit on a reverse mortgage, your available credit grows over time, even if your home value stays flat or declines. Banks cannot freeze or cancel your credit line once established. The unused portion grows at the same rate as loan interest, creating compounding optionality. After 2008, millions of HELOCs were frozen by banks overnight. A HECM line of credit cannot be canceled. Also, HELOCs are typically good for a period of 10 years, and if you use it, you still at minimum have to make interest-only payments. So the illustrative growth in this next table shows with a $300,000 line of credit, by year 5, this is assuming you don't touch it, that grows to $390,000. In year 10, it grows to $507,000. In year 15, $659,000. This illustration is based on a note rate of 5.5%. And remember, it's independent of home value. A strategy in action. So this is just an illustrative example. Let's say we have a client who's age 72. His or her net worth is $1.8 million. Their primary home, $650,000, is owned free and clear. And the portfolio they have is $1.1 million diversified. If this situation, they establish a $300,000 line of credit during stable market conditions and no draws are taken, it will continue to grow as you saw in the previous chart. What if the market drops 18%? Instead of selling depressed portfolio assets to fund living expenses, how about drawing from the line of credit so that you don't have to touch your portfolio and allow it to recover? Because long-term sustainability is improved by avoiding sequence of returns damage. Is a HECM worth exploring? Well, you might want to ask yourself if it's a good fit. Am I 62 years or older, and do I have a significant equity stake, meaning 65% or more equity in my home? Do I want to eliminate a mortgage payment? How would that change my monthly budget? Am I looking for a liquidity buffer during market downturns? What about delaying Social Security for a larger benefit? Every year you postpone Social Security is an 8% increase. Planning for health care or long-term care costs. And some things worth considering, if you are planning on moving within the next 2 to 3 years, then a reverse mortgage is not the program for you. What if your portfolio liquidity is already strong? What if you have the intention of maximizing what you want to pass down? Or what if you're uncertain about long-term home maintenance? Those are things that you want to ask yourself. What I say is you've earned this. Your equity isn't just a safety net, it's a life you've already paid for. Most people spend 30 years building equity in their home, then spend retirement being careful not to touch it. But here's the question worth asking. Why? Your home equity belongs to you. The HECM gives you the ability to enjoy it on your terms, without selling, without moving, and without a monthly payment. You could see the grandkids, fly out for birthdays, drive across the country, be the grandparent who shows up, not the one who has to think about the cost. Travel while you can. That trip to Italy, the Alaskan cruise, the national parks tour you've always talked about. Your 70s are often healthier than your 80s. Go now. Help your family today. A down payment for a child, tuition for a grandchild, a wedding gift that doesn't drain your last liquid dollars. Generosity funded by your equity you earned that you can witness today while you're alive. Renovate and enjoy home. Kitchen, bath remodel, modifications to age in place, the backyard you've always wanted. Why save it for all the heirs? Live in the home you work for. Upgrade it to your liking. Don't liquidate to relocate. The HECM for purchase, one of the most underused strategies in retirement real estate. The conventional approach is sell the family home, take the proceeds, buy the new place outright, or take a traditional mortgage that requires income qualification. The result, your liquid assets take a major hit right when you need them the most. The HECM for purchase approach, use roughly half the purchase price as a down payment, The HECM covers the rest with no required monthly mortgage payment. You can downsize or right size, move into a lower maintenance home community. You can actually upsize. Instead of paying cash for the home that you wanted, you can buy a more expensive home with that same amount of cash and still not have a payment. How about buying a vacation property near the beach or the mountain? Spend summers there. Let your home equity fund the purchase, not your savings. How about relocating near grandchildren? Move to a new city without wiping out your savings to buy in a market you're not sure about. The stigma that stuck. A reputation built on misunderstanding and the academics who corrected it. For decades, the reverse mortgage carried a label. It was called a loan of last resort, something you turned to only when everything else had failed. That reputation stuck in the public mind, even as the product was federally reformed, FHA insured, and substantially improved. The problem with that label is it caused millions of homeowners to ignore one of the most powerful financial tools available to them in retirement, not because the tool didn't work, but because they'd been told it was a sign of failure. Then the academics arrived, researchers with PhDs and no commission to earn. What changed the conversation? Multiple credentialed scholars across economics, physics, and public policy applied rigorous quantitative analysis to the reverse mortgage. They had no financial interest in the product. They just ran the numbers. And what they found? The modern HECM is a sophisticated, versatile financial instrument. When used proactively and strategically, it improves retirement outcomes in measurable, documented ways. This was not a marketing claim. It was a peer-reviewed conclusion. Dr. Wade Pfau, PhD in economics, professor, American College of Financial Services, also an author. Quote, "A reverse mortgage can be a powerful strategic tool, not a product of last resort, but a proactive component of a well-designed retirement income plan." Dr. Pfau is among the most widely cited researchers in retirement income planning. He argues that financial advisors who ignore home equity are leaving one of the most powerful risk management tools off the table. In his book, Reverse Mortgages, How to Use Reverse Mortgages to Secure Your Retirement, he provides the full quantitative framework, making the academic case accessible to consumers and advisors alike. The problem that he solved was the sequence of returns risk, the central challenge of retirement income. Imagine two retirees with identical portfolios, same average returns over 20 years. One retires into a bull market, the other retires into a crash and sells shares at depressed prices to cover living expenses in year 1 and 2. Same average return, completely different outcome. The second may run out of money a decade before the first. The HECM as a solution: draw from the HECM line of credit during the down years, leave the investments alone, let the portfolio recover. The result: dramatically improved long-term sustainability without requiring higher returns. Dr. Jack Gutentag, Emeritus Professor of Finance at the Wharton School, University of Pennsylvania, also known as the Mortgage Professor. One of the best engineered financial tools of our generation. Dr. Gutentag spent his career as a consumer advocate in the mortgage market, earning the nickname the Mortgage Professor. He evaluated hundreds of mortgage products over decades. His assessment of the HECM was direct and unambiguous. It's not predatory, it's deliberately engineered. The HECM is FHA insured, federally regulated, with consumer protections built in by design. Gutentag's verdict: well constructed, not exploitative. Why the Wharton name matters. A Wharton Emeritus endorsement carries real weight. It helped move the planning profession permanently. Dr. Barry Sachs, PhD in physics, tax attorney, a physicist, precision applied to retirement income. Dr. Sachs co-authored landmark work published in the Journal of Financial Planning. Using mathematical modeling, he demonstrated that a coordinated strategy, withdrawing from the HECM during market downturns and from the portfolio during recoveries, dramatically improves long-term portfolio survival rates. His simulations showed retirement success rates improved by up to 20 percentage points, not through higher investment returns, through smarter sequencing of withdrawals. Dr. Barbara Stuckey, PhD, public policy researcher, testified before the United States Congress. She took her argument to Capitol Hill. She testified before Congress on the important role of the HECM in helping seniors age in place independently, preserving both dignity and financial capacity. Aging in place is not just a preference, it's a documented health outcome. Remaining at home through retirement is linked to better physical health, cognitive longevity, and quality of life. Dr. Stuckey connects HECM access directly to these outcomes. When Congress hears it, the conversation is moved. Congressional testimony signals that HECM's role has crossed from academic debate into recognized federal policy. That's a significant shift. So we have 4 scholars, 1 conclusion. Dr. Wade Pfau, he says the HECM directly addresses sequence of returns risk, the central challenge of retirement income planning. Dr. Jack Gutentag, one of the best engineered financial tools of our generation. Dr. Barry Sachs, coordinated HECM withdrawals improve portfolio survival rates by up to 20 percentage points in simulations. And Dr. Barbara Stuckey testified before Congress. The HECM plays a critical role in helping seniors age in place independently. This is the academic record. It's not talking points, it's not marketing, it's peer-reviewed research, congressional testimony, and published books. What this means for you? The shift was permanent. These academic endorsements didn't just nudge the conversation, they changed it permanently. The reverse mortgage is no longer seen by serious researchers and planners as a measure of desperation. It is a recognized strategic tool, one designed specifically to address the real risks of retirement. And as a specialist, here's what I want you to know. The question is no longer whether home equity belongs in a retirement plan, it's how to integrate it wisely and whether you want to do that now while your options are greatest or later when they may not be. Let's have the conversation. You can email me at ryi@nexalending.com. We can schedule a phone call. There's no pressure, there's no pitch, there's no obligation. I just want to be able to provide education so you can make the decision that's best for you. We'll take a straightforward look at whether your home equity belongs in your retirement plan or if you should actually tap into it. And the last thing I'll say about reverse mortgages, they're not credit score driven like a traditional mortgage. They take into consideration your willingness and capacity. Thank you so much for your time, and I look forward to hearing from you.